Hello everyone, this is Nuresh Mirani from nureshtech.co.in. It's great to have everyone on a Saturday afternoon, a time which I've preferred so that's the time when my kids sleep. So I can't be doing sessions all the time. So let us start with the session today. How to trade small caps and mid caps using technical analysis. So this is a very interesting presentation because we tend to worry a lot about small caps and mid caps, and we have a lot to worry because they are very volatile and they also are big movers in the good times. So, quick introduction about myself. I'm an IT engineer by qualification. Got into equities around 2005, rather May 2004. My first introduction to the markets was the big lower circuit for the first time called Black Monday, 17 May 2004. Was trading all through my final year of engineering. Worked in an IT company for 6 months. Quit that, started blogging way back in 2004-5. I used to earlier write on Orkut, then it became Blogspot and various other ways. So over the years, I've been very active on various social media. So the joke is, say a cousin used to joke, what does Nuresh do? He's on Facebook. That was the joke before Orkut before. So it seems like all I do is blog, tweet and chat. I've been full-time into the markets for the last 13 years as a trader, advisor, blogger and various. I've been also on the sell side, etc. I'm not a qualified individual for equities per se, so I'm not a CMT, not an MBA, CFA, CA, but it's all out of experience. So I'll be discussing a lot more about the experiences trading small caps for the last decade or more. Over the years, maybe I've written more than 3,000 articles on nureshtech.co.in, right, starting from 2005, where all the articles are actually available on the website. Here's my teammate Harsh Doshi. He's a senior analyst he writes the content, he does everything. So a lot of this presentation has been done by him in terms of, so he's the go-to guy for me in terms of everything around the business as well as on the content. If you have any issues, you can always contact him. His number is there. So today's agenda will be, just a minute before we start, we'll see. I think everyone is here. Most of the people are there, so I can start. So today's agenda, there are 3-4 things we'll discuss. The main parts are in the first 2 parts. I think I have to just start my webcam, which is done now. Started the recording also, so I can now start the session. So today's agenda, when to trade small caps, when to trade mid caps. So these are the 4 points I'll cover most of it. But the first 2 is where we'll be putting like almost 90% of the time, and maybe the last one will have a lot more in the Q&A. So when to trade small caps and mid caps, that is going to be the first focus. What chart patterns, what sort of things which we look out for in terms of price action to focus on what stocks to trade. Third is a very critical part of small caps and mid caps is volumes and delivery volumes. So this is what we'll focus on, and rest is a little bit of ride the trend and risk management. This is a very personal thing, so everyone will have a different risk appetite. So we can't go have a general view around it. But these are the 4 content areas which we'll try to cover. So before that, we start a quick joke. So there are so many advisors, so many trainers, so many technical analysts, and I think there are a number of webinars which are happening, and I'm one of the culprits also now. So this is the nice joke. I followed your investment advice and lost all of my savings in the stock market. Did I mention that past performance not an indication of future returns? Then how does advice actually work? It only works for the people that give it. So being an investment advisor for the last few years, this is a nice thing. So I've been part of this for a long time. So advisory is a great business because what happens in advisory is you get the money first. And that's why we see a lot of people giving a lot of advice without great work being done. Next, a nice joke on technical analysis. You should buy a stock whenever the chart looks like a squirrel sitting on a clown's shoulder. That's called technical analysis. I'm not going to do that. Good, because it doesn't work if everyone does it. So I think the number of registered investment advisors are very less in India, but I think there are more advisors and trainers than actual traders, it seems nowadays. So cutting the time pass out of it, let's go to the topic. Let's get started. So before I start, the way we will be functioning is I'll be taking you through the whole presentation. It has a lot of examples. It's mainly full of examples. Once we are done with the presentation, which I think should last between 40 minutes to 70 minutes, depending on how my flow goes. Once that is over, we'll have a open time frame for the Q&A. We'll try to take the Q&A via the Q&A box. And if possible, maybe take 4 or 5 questions where you can actually talk, if that's possible. Please go through the whole presentation. We are not going to share the recording per se. And this is something which we are very clear because we don't. And apart from that, standard disclosure, none of the stocks covered here are not an investment advice. Most of them are past examples. And even what I talk in the Q&A, nothing of that is to be considered as investment advice. Please consult your investment advisors. Standard disclosures, at times, if I talk about stocks, I might be holding some of them. So there would be vested interest. So please, so I'm done with the compliances part. Now I can start freely. So now we go to the first part, when to trade small caps and mid caps. So this is where most of the mistakes happen because it is very easy to get into small caps and mid caps because they move much faster and say quicker. But one of the biggest mistakes we all have done is continue to trade small caps and mid caps heavily across market cycles. Because I've been a small cap, mid cap trader, investor over the years. And that is the biggest mistake I've made, is trying to keep trading small caps and mid caps at same position sizes all through the cycles. At least a few of these things should be happening. So best is when all will happen, which is not going to be the case. It will happen once in a few years. So these are the criteria when we have to trade small caps and mid caps. If you can do this, majority of your problems are done with. Because in a good trend, small caps and mid caps do amazingly well. You can say, do akkad bakkad Bombay bo, ye stock le lo, and it will work. And we've shown it through random portfolios as to how in a trend, a random portfolio beats the indices by 3x, beats even the small cap index by a good percentage. So that is where the first part is, when to trade small caps and mid caps. If we can, and this is extremely difficult to do because there could be very long periods of time when you're not supposed to trade at the same size. So there are 5-6 points which we try to look out for in terms of when we want to trade. So the first one is Nifty is in a higher top, higher bottom formation. Simple Dow theory, where Nifty is making new highs. It has shown you some sort of trend reversal. So if it has crossed maybe 2 higher tops or at least 1 higher top. The second is even the small cap and the mid cap indices like BSE small cap, Nifty small cap 100, CNX mid cap, BSE mid cap are also in a higher top and a higher bottom formation. The third part is no divergence in BSE small cap to the Nifty. We'll go to this part in details, but what we want is, we don't want BSE small cap to be moving 3x the Nifty. So for example, a very simple criteria, Nifty is up 5% in a month, BSE small cap is up 15-20% in a month. That is the time we get a signal as to, okay, we need to pause here. We need to rethink. We'll take this in detail. The fourth part is, the best condition is long-term breakout in major indices. Now, when this long-term breakout happens, it will also be an indication that the point 1 is also there, which is Nifty is in a higher top and a higher bottom formation. So an ideal combination would be higher top, higher bottom formation, long-term breakout, as well as the small cap index breakout. It generally does not coincide. A long-term breakout in, say, indices may not coincide with a small cap and a mid cap breakout. The fifth one, positive divergence followed by a breakout. So a positive divergence or a divergence of the BSE small cap with the Nifty. This is where I think it is better covered by an example rather than me explaining it now. And the last one is relative strength in small caps and mid cap indices. Now, there are times where the major index is not going anywhere, but there is relative strength in small caps. So for example, the Nifty is down 5-10% over a 3-month period. The small cap is down only 5%. It is falling lesser than the indices. That is the time you'll get new leadership stocks, and that is where you'll be able to participate. So let me take you through the example. So what we've done here is, below is Nifty 50, above is the BSE small cap. It's a chart right from 2008. We'll try to see examples more from 2009 time periods. So this is what we want. The best time you want to trade is, say the markets have reversed here. they've crossed the last two tops. So this is where the reversal has happened, and you want to participate in this move where Nifty is also making higher tops and higher bottoms, and the small cap is also making higher tops and higher bottoms. So this is the most say fertile period to trade small caps, and this is the time where you can say you can buy any small caps, you'll be right 60% of the time. So this is what I call akkad bakkad Bombay bo, jo dikhe wo le lo. So this is the time where wherever you see price action, you can buy, and you will be right more often than not. So this is where you want to play the breakouts, all technical reasons. So this is the higher top and higher bottom formation. The next one would be this big period where you have a long-term breakout on the Nifty. So we've crossed about 6,400 Nifty, which is like a 6-year high. Now look at the small cap index. It has not broken out into all-time highs, but it has just crossed the previous highs. It has crossed a lower trend line. And this is where you want to participate. So this is the most fertile period. So this is where you want to participate. Nifty broken out, the small cap and the mid cap, and they are both in higher tops and higher bottoms. Then we go to the next part. This is what we call as relative strength. The Nifty is in a lower top and a lower bottom formation, but small caps are showing resilience. So wherein they are not dropping as sharply as the Nifty, but they are flat. So they are not breaking out in this full year. And this is the time you want to trade small caps, but you want to be very, very selective. So you want to buy relative strength. So you want to buy stocks which are hitting new highs even when the Nifty is not. So this is where we've taken examples in the sectoral analysis part, which we do. And we've also covered this on our website back in 2015, where we spoke about textiles and chemicals all through the cycle of 2015-16. The Nifty topped out in March 2015. And it was down over the next 6 months. But in the same 6 months period, you had textile companies making new all-time highs. You had chemical companies making new all-time highs. Aarti Industries came out of a 20-year rut. And this is the time you want to buy relative strength also. So out here, you can't be buying any price breakout. You want to buy structural breakouts, which are showing relative strength in the small caps and the mid caps. Then we come to the next part. Again, this trend reverses. Out here, we start making new highs here, breakout, and higher tops and higher bottoms. And then we get a signal here in terms of divergences, which we'll see. So where it tells you now you have to stop participating. The next fertile period is when there is a nice double bottom reversal here on the Nifty, a double bottom reversal here on the small cap, post demonetization. All the confusion is prevalent, but the prices start reversing. And this was the cleanest year. So when the previous US elections happened, the expectation was the markets will crack, but we got the cleanest year. When I say cleanest year, it was one of those years where global markets across the world did not fall more than 6 to 10% from the highest point to the lowest point. And this was the period where small caps went really fast. So basically you want to be participating in this up arrow zones. So this is the best time to trade small caps and mid caps. Now, generally, this is what happened for the first time in a long period was, so earlier, and this was one of our biggest mistakes. So we screwed up really bad in 2018 to 2020 because the Nifty was in a strong uptrend. So we did get out here, but we got in early in terms of a divergence in the mid of 2018. And then we got smacked out really bad in this period because the Nifty was still making higher tops and higher bottoms. And we expected the divergences to play out in the small caps. We would get 10-15% bounce on the BSE small cap index, and then the Nifty would crack. But overall, this was in an uptrend, this was in a downtrend. So this was the big mistake. So since then, we've added one more thing where we don't want to participate is when there is total, till the time this is not reversed, we don't want to participate. So that is one more addition. We want to increase participation as the reversal is confirmed in the small cap indices, not just the divergence. Then we started seeing this change out here. We saw a breakout in the BSE small cap index. The Nifty went into a new fresh highs, and everything was seeming in terms of that the small caps have finally changed their trends, something similar to previous times. And then COVID crisis happened. So this is called bad luck because this was not in your hands. A lot of people will talk about risk management, etc. But the fact is, everyone was worried about everything else which could have happened. If somebody could have predicted the COVID crisis, he might be wondering about how to find an island or find as many groceries possible. So this is what will happen. So this is 2008, which comes out of nowhere. So this is something which will happen, and that is why you need risk management in terms of where you don't get totally killed. You get a drawdown, but not a wipeout. And then again, we started crossing new highs somewhere in June. So that is where you start participating and increasing your size. So everyone wants to buy the bottoms, but what we've realized is you can leave the first 20% away in the small caps. And when the trends turn, you get more right. So from June to say September, you would have got an 80% hit ratio if you were buying technical breakouts. And going forward also, when this trend continues, say we are now getting close to a 2-year resistance, which will eventually break out over the next few months or the next 1 year, 1.5 years, whenever that happens, that would again be a fertile time for trading small caps and mid caps. And that is what, so as of now, there is no change, but that would be major, say, momentum indication. So that is where you want to be. So this is one of the reasons we are doing this presentation today, so that going forward in the next couple of years, a few months, etc., there will be much more opportunities. And that is where, if you are good at doing technicals and understanding price action, you'll get some of the best opportunities. So again, so to sum it up, you want to participate in the good times and participate real hard. Then a quick example as to the best periods. So the best periods are, you've got a divergence. What I mean to say divergence is, the Nifty is higher from the lows of 2011 as well as 2012. So it is, this low was around 4,500. The Nifty was 5,100 to 5,500. But the BSE small cap actually made a new low in 2013. So this was painful 2 years period between 2010 to 2002.5, 3 years period. And then what do you see? This is where you want to participate. The reversal has happened. The Nifty has broken out. And then you get a clean move for the next 3 years. Same way, you get a big breakout, a nice cup and handle breakout post demonetization on the Nifty. Out here, there has been a good dip. This had broken out into all-time highs here. And then you get a nice reversal. So these are the two periods where you want to magically be all into small caps and mid caps. So this is the ideal places where you want to be. So your best case scenario is a major bottom has happened. So in the same way, if you look at the current move, we've got a very nice whacking for the last 2 years plus. And now we've started reversing. So now we are, say, over the next couple of years, we could be getting into a time where a lot of things start going right. So maybe there can be corrections in the next few months. But the point is, when you look at the longer term structure of the small caps, you're close to a 2-year high. Maybe we consolidate here much longer and then we break out. We may consolidate here on the Nifty. We may make a nice cup and handle just like previous times, and then the breakout happens. So eventually, over the next, say, few years, it's very, very exciting, because now you will get into a time where both opportunities will come together. Now we go to the next part. So this is all Anki Dory. When you want to be invested, when do you want to get out of small caps, increase cash, and reduce your size on the small caps? And if this can be done, the whole, say, return profile will change in a big way for everyone. So we call it BSE small cap and the Nifty divergence. So what are the 3 simple criteria? BSE small cap going crazy and bonkers. Like we say, gade, gode, hathi, gode, sab kuch ud raha hai. Every stock is flying. It doesn't matter, it is good, bad, ugly, unknown names are flying out of nowhere. The BSE small cap is doing a 3x move to the Nifty. The worst case scenario is, so this is over momentum. The worst case is Nifty is struggling to make new highs, or rather making new lower tops. But the BSE small cap continues to do well. So this can last 2-3 attempts. So it does not imply on the first attempt it will start cracking off. It lasts a few weeks. So it can last, say, at times it has lasted 3 months also. But you will get the indication first, these are the periods where you're riding, but you know, okay, boss, this is the time where I have to not put new money to work. I will ride, but I'll be extremely cautious. Do not use leverage. Now, why do we look at BSE small cap index? Because nobody looks at the BSE indices, right? So there was a time when we used to not look at the Nifty, only look at Sensex. But now the most traded, say, index is the Nifty. And the most tracked indices are also the Nifty mid cap. The reason we look at BSE small cap is this is an amazing index. When I say amazing is the structure is so beautiful in terms of, say, it will give you pure reasons as to understand, okay, these are extremely euphoric frothy times and these are extremely pessimistic times. So we call it the best Kachra index of India because it is designed to represent the bottom 15% of the total market cap of the S&P BSE all cap. So what it implies is even if the companies have a lot of Kachra has gone off, few companies have become small caps to mid caps, this will always represent the last 15% of the total market cap. So say if our market cap is 100, it will represent all the companies from the 85 to the 100 part. So it will represent the bottom 15%. And that is the reason there will be no limit on stocks. So it will never have, say, limitations of number of stocks. It is generally much more well diversified index. As of now, the index has 678 stocks. I remember it had 860 stocks also. So, and it is still at the same price as it was in 2007. So, for example, we are still there. So, even after ins and outs, so this is not ideally a survivorship index. It's ideally a survivorship index implies what? Suzlon was part of Nifty. It can never come back. Here, things will remain there. So the Kachra will remain there. The only way you get out of BSE small cap is either you become big or you become delisted. So it will keep on showing the structure of the real small companies in India. And this gives you the best indication. So let me show you how. So this is BSE small cap. So now look at this. So this is a higher top, higher bottom continues. Now this is a lower top on the Nifty out here. But if you see, it keeps on making another new high, another new high, another new high. So this is your first indication of the divergence. When I say the first indication, this is where you've got a lower top and you've got a higher top here. And then it goes bonkers over the next 2-3 months. When I say bonkers, this index was up 20 to 40%. And in the same period, we hardly had a 10% move on the Nifty. So this is what I called as the 3x move. So this is where you want to get out, but slowly. You don't want to rush away because in this period, the index goes up from 10,000 to 14,000. And this is where majority of the money is made. But this is the time you make a decision. I will not put any new money into the markets. I will not use leverage. I will be slowly and steadily cutting positions which I have. So whenever you start seeing this divergences, this is the time where you get in. There will be another 1 to 2 months where you will get the opportunities. We'll go ahead also. Right. So this was 2008. And you'll be ready to get off on the first break of the last swing low. So you should be out here. And even if you're out here, say even in this period, you'll be at the same prices where you were 4 months back. It's just that it becomes difficult to exit in such periods because you've seen a stock go from 100 to 250 in less than a couple of months. And then you're supposed to exit at 180 to 200. So that is where you have to realize, and that realization will come if you have spotted it here. So that you're riding from 100 to 150 and 150 to 250 is just too much. And you know it, okay, this is going crazy, but you're riding it because you don't know how higher it can go. And once you have that realization, then you'll be able to get out on the way down. So a few indications like convergences, etc., which we look at, allowed us to get out into June 2000. And that is the reason I'm still speaking and I'm still into equities. Same way, what would be the opposite of it? The Nifty is at the same place, but BSE small caps are falling down. So that is where pessimism is extreme. Because between this period to this period, the BSE small cap is already down 70%, 65-70%. The Nifty is down 55-60%. So it's already gone down a lot. But Nifty is almost at the same prices or a higher bottom between 2008 October to March 2009. But BSE small cap is just getting killed, makes 2-3 new lows. This took 6 months. But your first indication came here. So after the indication, it took 3-4 months. So this is the time you want to do what? Start deploying money into equities. And this will be only possible if you have pulled out some money out here and pulled it out totally. We'll discuss that about in the risk management part, how much to remove and what to do. And that would be very, very interesting because that's some of my learnings which have come from a mentor who's no more, but he's been around. He was an investor for almost 35 years. And this is where the first breakout happens. The recent swing highs get taken off. So this is where you want to participate. Everyone wants to participate here, but this is the best place to participate. Same way, all of 2015, every time lower tops on the Nifty, higher top on the BSE small cap, you get a nice correction. You get the correction in the Nifty also. Low tops on the Nifty, higher tops on the BSE small cap. So this is what you don't like. And if you see it, in this case, it did not last. In this case, it lasted for a month or so, wherein it continued to stay higher. But this is where the final correction part comes in, where you've got a lower top, but you have a higher top on the Nifty, and then you get another 1 to 1.5 months to increase cash. And this is before the US elections, as well as demonetization came out of nowhere, which was not expected. And then you get a 25-30% drop in the small cap and a 15% drop in the Nifty. So this was the big indication before the demonetization correction. Then look at the opposite side, almost the same bottoms, but a new low on the BSE small cap. So this is the divergence. You don't want to buy here, you want to buy here. Sorry, this was not demonetization. This was February 2016. And this was the demonetization move. And you would see very similar criterias, lower tops and higher tops on the Nifty. Now look at this case going into demonetization. We've fallen from 8,900 to 8,500 by the time we are coming into US elections. But what is happening to the BSE small cap? Making 3-4 new highs. Out here you got 1.5 months. Out here you got almost 1.5 to 3 months. So you will get your first indication here when the lower top comes on the Nifty and a higher top on the BSE small cap. And this is the period where you want to ride, but you don't want to put new money and increase cash slowly over the next 1.5 months. And before the event, we had broken below 8,500, and then the event comes. The new lows out, almost same lows on the Nifty, almost same lows on the BSE small cap. So we did not get a divergence here, but you got a reversal here. I remember actually posting an article around this period as to how multi-baggers as a keyword had hit a high higher than the 2007. So it hit a relative high because Google Trends is relative to 2007. So everyone wanted multi-baggers here, and then we got a nice 25% correction. And this became the cleanest move. So the markets tend to surprise you on the side which you expect the least. So post demonetization, everyone expected much bigger hits, but the markets continue to surprise on the upside. So now to sum it up, this was the first part of the session. Very important, because once you've been able to decide where not to participate, a lot of your mistakes get done with. So major fatal mistakes do not happen. So now today, if we look at our markets today, going back to the previous chart, where are we today? In the short term, we've actually made a new high on the Nifty, but we've not made a new high on the small cap. That is fine, because that happened for a long period between this period. That was all okay. It is not scary. What is scary is where Nifty is struggling and the BSE small cap is going bonkers. So as of now, there is no condition of a major, say a lot of froth or euphoria in the small caps. Rather, you can call it more of a froth in a lot of large caps, because some of the stocks have done really well. Now we go to the part where we look at what patterns we look at. So now we'll look at what technical chart patterns we try to look out for when trading small caps and mid caps. So the chart patterns which we look out for are triangles and cup and handles. So we'll cover triangles first. So it will be mainly symmetrical triangles and ascending triangles. Now, what is a symmetrical triangle is? Now, when we look at symmetrical triangles in respect with a small cap and mid cap, the implications are very different when you try to look at with a large cap. So what is happening in this case is, it is basically the range for the stock, the swing range for the stock is reducing. Now we know stocks cannot stay in a 5% range forever. So the textbooks tell you that you make two trend lines, make the triangle trend lines, more than 3 attempts on both the sides, and various sorts of theoretical parts. Then it tells you how breakout has to be after 60 to 75% of the size. But we know it practically, it will not be exact. But the case here is what? When the range gets really tight, you realize most stocks in the small caps cannot stay in the same range for a long time. So they have a tendency to blow out. And in symmetrical triangles, in small caps, most of the times, it tries to blow out on the upside. Why does it happen so? In terms of a large cap, it can be either side, because small caps have a very strong trend. So when they're going down, they don't consolidate a lot. They keep just going down. They fall off really fast. So what happens when we look at symmetrical triangles? We can say, if I consider, say, my probability of, say, it is X breaking out on, say, if the probability is X breaking out on the upside on large caps, it would be X point, say, 50% more in small caps to be breaking out on the upside. So basically, the range is consolidating. How do we take the target? So this is the full target. So for example, this is 100, this is 150. The breakout is happening at 120. You expect 170 as the target. You can cut target prices even shorter when you take the last swing. So you can take this much range or this much swing. So you can take smaller targets also if you don't want to ride the whole move. So you can take the last swing, which could be, say, 15%, and that would be your target. The most critical element here is when the price breaks out above the triangle, you want volumes. And the volumes you want is, say, if the previous traded session is, say, 1 lakh shares, average volume is, say, 1.5 lakh shares. So 1.5 lakh shares are the average. You want 2 lakhs volume on that day, or at least 50% higher than the previous day. It could be 3x, 4x ideally. So that is what the volumes you want. You want a nice 3-4% uptick or more. And that is where you want to participate. So this is the symmetrical triangle. This is the ascending triangle. Then you could have sloping triangles. You could have consolidations, very weirdly shaped. It could be pennants. It could be flags. It could be wedges. But you have to use common sense that the stock is in a very tight range. And that is the time you want to concentrate on it. And that is the time you want to look at price action and volumes. Because your decisions would be governed by what happens on the price action and the volumes. When the volumes and the price action happen, you want to catch in early, and your stops have to be really small. And because the consolidations are happening, your small stop losses are really small. So if your stop losses are small, the move is going to be large and in an extremely short point of time. Why extremely short? Because it's like a compressed spring. A triangle pattern is like a compressed spring. When it blows out super fast. So that is the reason we like triangle patterns, because if we get it right, things move right really fast, and my stops are really small, because even if I take the last swing low, I've noticed we don't get more than a 10% stop loss taking the last swing lows on the breakout point. Even if you take 5% higher from the breakout point, you get 12-15% stop losses. I am saying if I take a stop loss at the 20-day moving average, 10-day moving average, whichever you prefer, then your stop losses become 5 to 7% and your upsides are 15% or higher most of the times. Now, why do we look at volume so importantly as we go further at the next part of the session, where we'll look at why delivery volumes are very, very important. So why do we look at volumes a lot? This is the structure of Indian markets. Promoters own 45 to 50% of the market. FIIs own another 20-25%. DIIs own around 12 to 15%. Now, these are not just assumptions. We've actually done this numbers. We've come out with a very huge report called Flows to Floats 3-4 years back, again a few months back. So we've actually done numbers. We've actually tested it through the data, and this is the reality. In India, the actual float available is 10 to 15%. Why do I say 10 to 15%? Theoretical is 10 out here, but FIIs, DIs also trade. But that does not imply all of that 20% comes into the market every day or every month or every year. So a lot of these is very long only funds. So if you see, mutual funds generally do not exit and enter a lot of stocks in a big way, because they can't go beyond 20% cash in most of their scheme mandates. So this is a very sticky, say, holding. And promoters can't sell easily because the market takes it very negatively. This is for the whole of Indian equity, say, which is 150 lakh crores market cap. But when we go to mid cap and small caps, it gets much more aggravated. Promoters own 50 to 75%, in a lot of cases 60, 75%. Plus they own unofficial holdings via their friends and family, say vendors, suppliers, etc., which are really long-term investors, or some of it is not. So nowadays, at least, a lot of the holdings are dematted. Few years back, when we used to look at 5, 7 years back, there would be a small cap company where 3 to 5% of the equity is not even dematted, so it is not going to come into the markets. So now what happens is, why volumes become important is, if an institution or a HNI or an individual really likes a company and wants to accumulate large blocks of it, it has to be traded via the exchange. There is no other way you can trade it. There is no, say, dark pools here. So if he has to buy, and the float is less, so if you want to buy a decent quantity, you'll have to take the price up and accumulate. And that is where it will directly be visible on our charts. So the fact is, when we are buying technical chart breakouts, we are actually following some really smart people who have taken the bet, or some really risky people, whatever you want to call them. You want to call them operators, you want to call them, say, HNIs, institutions. But what you're doing is, you're getting right away into the train with them, just with the first 5%. And many a times when we make short-term profits of 30, 40% in small caps, this could be an impact cost for that investor to buy a huge chunk. So if you buy the stock at 100 and sell at 130, 140 in quick time, this is actually a cost somebody has taken to accumulate shares. So for example, if I like a company which could be a multi-bagger, I might be buying a few lakh shares from 100 to 140. Average price would be 125. I think over the next 3 years, it could be 500. So if your trade is that 30, 50, 100%, it could just be an opportunity cost for someone else. So that is how we look at the structure, and that's why volumes become important. So you want participation to increase. So the anecdotal part or analogy which I take is, we as technical analysts want to be going to a fine dining place right at 8:30, so that you get in and there is no waiting. And then there is a waiting of 45 minutes to 1 hour 30 minutes. I'm talking very excitedly about pre-COVID times, but suddenly the food starts feeling so much more delicious, because then when there are lots of people waiting outside and you've already got a very nice table. So in the same way, what you want to do as a technical analyst in such situations is, you want to buy on the breakout, you want to be the first one, and there should be more volumes, there should be more people wanting to. Like for example, in the market, somebody is ready to take a stock of 100 from you at 130 rupees. Now that does not happen in dining, but if you give an option to somebody who is come out for a very important dinner, etc., I'll say, boss, I'll give you a few thousand rupees, please vacate the table. So the fact here is, this is what we want to do, and that's why volumes are very, very important. Now let me take you through this via examples. That is where it will become clear. There are a lot of examples. Standard disclosure, these are not, say, recommendations. Most of these examples are ones which we have traded, which we have advised. So it's not something on hindsight. Rather, we've focused on taking examples where we've actually executed, so that it's not a lot of hindsight biases involved. And we'll also take a lot of failure examples, so it will become clear as to how it works when it does not, when you thought that the breakout will work, but it does not work, and how much do you get hit. So this is an example of IFB Industries. After the big fall in March, went sideways. We've taken all recent examples so that there is some memory around it. Now, if you see, nice consolidation, tightening of the range, nice 3 tops on the trend line, one more top here, and then it breaks out here clearly. And this is what we look out for, a tight range before the breakout. So this is an indication of the stock not wanting to fall, because generally what happens, this is how the falls happen in small caps. It does not stop. And this is not just March 2020. If you go back also into various small caps, this is how they tend to fall. The breakout happens. So either you want to be buying in here, or you want to be buying in here. So in this case, we bought it here on the breakout. And you can see the volumes on the breakout. So the earlier case also, there were huge volumes on the breakout. So you could have gotten here and then hold on. Now, one more part which we look out for is, how much time do we have to hold, right? And what sort of volatility which could happen after you've bought. So if this pattern started in the mid of April and broke out in mid of August, so that's like 4 months. Our expectation is the target should be done in 20 to 30% of the time. So if it is 4 months, I would expect it to happen in say 1 month, my target prices. So if it does not move for 2 to 4 weeks, I would take a stop loss hit in terms of time, even if the stock has not hit in my price stop losses. So suppose if I bought at 450 and the stock is at 470 only after 1 month, I would take an exit because 20-30% of the time is over. So one, we have a time stop loss, one, we have a price stop loss. So if you're buying out here, how do you initiate the trade? What do you want to do is, there are two ways you can trade. One is during the market itself, and second is on the next day. Not at 3 p.m. because if you're tracking the markets, the breakout has happened at 12. Why do you want to wait till 3 p.m.? Because small caps run really fast. So this is where you can create price alerts on the breakouts. So for somebody like us who are always watching the markets, trying to scan for breakouts during the day because we've done all our workings in the evening, we don't really wait for the next day. What we do is we try to get in on the same day itself when the breakout is happening. What you can do is, even if you're not tracking markets, nowadays there are so many lovely applications and say utilities which are available. I think Harsh has done a really nice video on how to create price alerts on various applications. So you can do it on IFL app, Edelweiss app, Money Control, Sensible, VBull. Now I think one of them also sends you on a WhatsApp. So you get an alert on the WhatsApp if the price is broken out. You get a notification. So then you can go and check the volumes. So the criteria is what? Say yesterday it was 1 lakh shares. Today by 12 o'clock, 1 o'clock when I'm seeing the breakout, it is already traded 1.5 lakh shares. So it clearly tells you by end of the day it could be 2-3 lakh shares. So you want to buy at those times. So if the breakout is at 450, say my stops will be 5-7% if I take the 20-day moving average or the last swing low. So in that case, what am I looking out for? The target would be this sizes. So this is how it will work out. So this is the chart where the tight ranges happen, the breakout happens, you buy on the big volume day. Your initial minimum target is the last swing and the bigger target is the bigger swing. And it has played out really well. The stock has gone from 450 to 550 quickly and then 650 quickly. And I think it is much higher very recently also. So this is what we look out for. Volume on the breakout day. Now this 2-3 days, this is what people get really say kicked out of the markets, is people expect moment you buy the stock, all of them should just run away. Once you've bought the stock, it can go back into the range. Doesn't matter. Till the time it doesn't hit your stop losses, you have to stick with the position. You have to diversify, which we'll discuss at the end of it. But you're not, just because the stock goes back below the breakout levels, you don't exit. So if the stock would have come here, no exits. If your stop is at this price, you wait for either the stop losses to go or the time stop loss to go or the target to come. Another example, Hind Oil exploration. Can you see a big drop? Then the price is slacking off. And you can see the tight range here. So ideally a trend line breakout would have happened here. And this is the tight range. So this is where the breakout happens. Volumes are almost double. You just have to look at it visually. You don't need to calculate shares all the time. If you see the volumes visually, you'll get it. So this is double the volumes. Price has broken out. Your target is this size. And the trade plays out really well. So this is what happens to the stock the next day and over the next few days. Does your target goes from 45 to 65, which was your target, 60, 65. It went much higher also. Then it actually gave you another triangle breakout here. Then again gave you a 20-25% bump. And maybe it is on verge of a breakout here again too. So you'll get multiple opportunities if you keep looking out for trend changes. So this was a nice trade. And remember one more thing, not necessarily volumes will keep on increasing after you've got the first breakout. Because as the value increases, the number of shares, even same implies value is higher. So you don't want, on the breakout, you want the volumes to increase. After that, it could reduce also. So I'm trying to put in all, say, certain things which matter and which puts doubts here. Another example, Nippon Asset Management India. If you see, this is nice double bottoms creating a base here very nicely, then gets into a tight range, a small ascending triangle. So now you could call it a wedge also, and say essentially you don't want to be an academic. So see, whenever what happens in say if you want to focus, either you can focus on academics or you can focus on being a practical trader and investor, because technical analysis is all about observation. There is nothing technical about it. When I say nothing technical about it, if you take up a phone, if it says 2 GB RAM, when you go to technical specifications, it will give you exact. Like none of the bikes which we call it 150cc are always 150cc. Something would be 149.5. So that is technical specification, which is precise, which is exact. Technical analysis is not exact, so it is observational. So you can't be saying, okay, this is how it should happen. There's this many attempts. What you're trying to do using technicals is trying to spot places where you get a risk reward opportunity. Volumes are great. A lot of what your checklist ticks out, and then you buy, and then you hope you go right. And the fact is, you'll not be right 100% of the times. If you're right more than 80% of the times, it implies it's not you, you're great, the market is in a great trend. So accept that fact and you'll be able to trade better. So if all my trades between June to September have done well, it's not I am doing great or my analysis is great. I've just been at the right place at the right time. And that's why in the first part we focused on to be at the right place at the right time when trading in small caps and mid caps. So if you're in the right environment, you just don't need to do a lot more. You just need to focus on risk management. So in this case, nice, going back to the chart, nice double volumes, breaks out. You take this target as your target. You get a nice bump from 255, 260, as we see the next chart, to 300 in the next, 5 to 6 sessions. So see, this is the move which happens, does a retest, then goes higher. And this is where most people chicken out because people don't want to wait. So if this has happened for 1 month, you have to give it at least 1 to 2 weeks for the trade to play out. Now, in this case, the next breakout did not play out. So consider you bought the breakout here. All right, huge volumes, everything right, double bottom reversal. And there was no follow-up for the next few days. You still have to hold on. Where will you get stopped out? You'll get stopped out on the moving average out here or on the swing low out here. But if you keep holding after that, then it's not a false breakout. It's a false assumption we've made in terms of just sticking onto a position even when it has gone wrong. So a false breakout stuck position is not a false breakout. It is basically a stop loss hit which we did not execute. And that is our mistake. It's not the mistake of your analysis. Because the analysis tells you that you will not be right 100% of the time. So there will be false moves. There will be stop loss hits. So this is an example where everything is right? Volumes are 3x. Price has broken out. Recent highs. Sustains above that for almost 8-10 days and then flops out. So you get out here. So in this case, we were out here. So we did not take this trade, but ideally this was also a trade. Another example, a company which felt terribly because of the COVID crisis. Everything was fine, huge volumes. So this is called bad luck because the business is very closely tied with crude. And for example, this is where I got whacked because this was one of my good exposures. Then we added here when the trend changed. Nice consolidation of the range. See, the first fall is really sharp, then it starts making a range. And out here, very tight range, almost same prices every day. And then you say 2 days of huge volumes, double and triple of the previous day. And then the stock continues. And see, this 2 days, there were not circuits. Then it started hitting circuits. So it went from 58 to almost 85, 90 nicely. Then gave another triangle breakout here. And then went from 90 to 120. Now again, 120, 125 could be a zone where if it breaks out, could be headed higher. So this is where we are again. So you keep watching such trends and you'll get multiple opportunities when the trend is right. Another example, sharp fall NCC. This was a small triangle. Suppose you missed this because this was not a lot of sideways action. Here, can you see before the breakout, a lot of sideways action. Breakout with huge volumes. Then the volumes keep adding up. So this is where you get in. Now this was not exactly a triangle, more like a flag. So this is a flag where you expect minimum target to be this and maximum to be the pole target. So did the flag target really fast and almost did the pole target also eventually. Again, you got a similar opportunity here if you see the flags. Again, very recently the same. But which ones do we prefer? Before the breakout if there is a lot of sideways action. Because then our stop losses are smaller. It's not, we look out for this, but the risk reward fits happen when there is a sideways action. So this was NCC. And see, a lot of these companies are not, say, large caps or mid caps. A lot of them are real small caps. Another example, this is almost like a small cap which used to go on circuits and down circuits. IFL Securities, very similar to NCC. And if I put a small triangle here, you'll see almost flat action. Can you see almost same bottoms every day for a period of almost 6-7 sessions? Now that does not happen often in a small cap which is going down. So this is an indication where the stock is telling you, okay, a pause is here. Then big price volume breakout, almost 5x the volumes. So this is the day you participate. Your initial target is the flag and then your pole. So this is what happened to the stock after that. Very quickly did flag targets and did the pole target also and went much higher. So the stock went from 30 to 60 in less than 2 months. Another example, Motilal Oswal. Can you see the tight action? So this is the day of the breakout where you get in at 525, 550. A triangle trend line would have come here. This is much for simplicity as to even if you would have bought here when this tick happened. Volumes have doubled up. Now see, in this case, what happened? You bought here. So we bought here at 525, 50. The stock went to 600, then came back to 500. Luckily, just did not trigger our stop losses, then made the big move. Even in this case, if you would have a stop loss, you would have not lost much money. If you had a 200-day, you would have got a 20-day moving average. You would have got stopped out at 2% plus or 2% minus. So in this case, then made the big move. So this is the period where people start worrying because stocks may not always go in the same line. Now we'll take some more examples of another pattern which we like, which is called as the cup and handle pattern. When we talk about cup and handles, our preference are 3 simple things. Flatter the better. So this line has to be flatter the better. Longer the time frame between this point to this point, better. More attempts. So if there are more attempts here, multiple handles, we would like it more because that makes it a very important resistance. So when it breaks out, it can do a big move. We can only preempt if it is close to an all-time high or multi-year highs. So I might even preempt if I like a company fundamentally, if it's a good all-time high, known company. What is exciting here? Stop losses are small, not always small, but relative to the target prices, they are very small. So many a times the targets are 30%, your stops are 5-10%. And why do we like this pattern is because if you think your target is 160, it could go to 250 also. And it could go in a nice line. So I'll not take older examples, I'll take the recent examples. Now, this is Supreme Petro. Can you see a cup and a handle? Why does cup and handle work really well is because see, very few companies after a good correction can come back to the same prices really fast. And that's an indication of strength, relative strength in the business or relative strength in the perception which has suddenly changed. So a lot of companies which can make a quick recovery implies this was just a correction, a blip in the longer term picture. So this could be almost 6 months to 2 years, 5 years, 10 years patterns also. And when it can come back and then cross it, that's an indication of a major perception change or fundamental change. So this way, if you look at it, nice cup and handle breakout was resisting around 200 levels. Can you see 1, 2, 3, 4, 5, and the 6th attempt? So every candle high, if you see, this is 1, this is 2, this is 3, this is 4, this is 5, 6, and the 7th, 8th attempt it goes off. Now, if you see the first move, our cup and handle tells you your target is the cup. We take handle sizes also as our targets. So first target is the handle size. So you can play only for the handle or you can play for the whole cup. Not necessary So this could also happen a retest and then the full move happens. Sometimes this could happen one way. We've covered this pattern much more detailed in a YouTube video as well as in our online courses, where we have a lot more examples. So here I'm sticking to the simplified what happens after the breakout. So this was a nice cool 15% trade, then a dip, and then the big move. So you can decide what part of the trade you want to be. A very interesting chart which we looked at, Natco Pharma, a sloping cup and handle, not the most favored one. What we prefer is flatter the better, but this is also like a triangle breakout and a sideways range out here. And what was the most interesting feature? The volumes are 5x on the breakout. Now, when you see such a chart, you feel, okay, this will just blow out because everything is right. Huge volumes, highest volume in 3 months. But look at the price action, what happened in this case. Stock broke out, came below it also, did not hit your stop losses, just went to the swing low. This was just a gap down, closed higher, stayed there for almost 2 weeks, and then came the big move. But if this move was for 5 months, you have to give it 1.5 months. And in 1.5 months, it did go from that 640 levels to 850, giving you a 30% jump up. So you need to give it time when it's a bigger breakout. And the trend has just continued. So this is what we like in cup and handles. Then it became an all-time high and the trend continues. And the volumes were superb even before the breakout. So this is the tough period. And that is why you don't go overboard on a single stock. That's why you diversify. Now, this was a very interesting trade. So this is Unichem Labs. This came up in our insider trading radar. So the company has almost 160 to 180 rupees of cash. During the March correction, it fell to 80 rupees, which was kind of weird because this company had concerns of growth, but never in terms of the cash was always there. Then promoters bought on this 4 days. And now look at this. They've bought from 80 to 135. And in 4 days, every day they were doing 30 to 50% of the delivery volumes. So they did not buy a huge percentage check, but whatever they could buy from the open markets they bought. So that was a very strong indication as to something is changing in the company. So this came up in our insider trading radar. We actually came out with a stock story also for insider trading report buyers. So what did we do? We waited for the price action to shift. And when this sideways consolidation happened, so that is where it got onto our radar. So this day, we could get in at 140, 145 itself. On the day itself, then the stock hit the 20% circuit, then broke out the next day. And this was a nice cup and handle sloping breakout. But for us, the entry was on this tight range itself, breaking out. And this was multiple attempts on this trend line. And what happens to the stock? Now, what would you expect? Oh, it should just blow off. No, it will not blow off. It just stays there for the next 10, 15 days, gives you enough opportunities. And this is where most people get tired of stocks. But if you're looking at a breakout, which is for 6-8 months, you have to give it 2 months for it to do its work. And it can go back below the trend line. And that is where you have to realize your stop losses are more sacrosanct than a price trend line. So wait for it to do its move. The stock went from 140, 155. We got out a bit early, but it went to 280 over the next 2 months. And it still quotes at 270 and is now close to a breakout also now. So this is the kind of opportunities which cup and handle. So your target would have been much smaller. So your target would have been 200 and it did much more. And the volumes kept on increasing. Another example, Orissa Mineral Development Corporation, a circuit-to-circuit stock, very volatile, and then suddenly goes sideways. Nice symmetrical triangle, huge volume, 6x volume on the breakout. Got in at 1700. Nice 3 attempts. Now look at it. What happens? You would expect, oh, now it should just blow off into circuits. No, it goes back. So made a first 10% move, did a retest, went back to 1680s, 1650, 1700, below your entry prices, and then makes a move from those prices to almost 3,000. So in this case, we actually got out at this circuit and then it went on to hit another circuit the next day and then cooled off. But the fact is, this is the problem. So this is where you need to understand technicals as to how you have to position size and you have to wait in small caps. People expect after we buy, this should happen. But 4 days stock should be up 50%. It will happen in a few cases, not in all. That's why entry wait with your stop losses, be patient, let them move. If the stop losses go off, take an exit. Another example, Strides Pharma. So in this case, this is for simplicity. We got in here at 430, tight range, small triangle, got in at 430, breaks out above 450, 400, 500 very nicely, and also breaks out on a multi-year cup and handle. So this is where this was a preemption. Preemption is because we missed out on a lot of API stocks. Then okay, this one is there, and this is also breaking out. Risk reward is amazing. So we got in here, and then it makes a nice cup and handle breakout, and the volumes keep going up as the stock goes higher. The stock went from 430 to the target price of 600, 650 really fast, and went to 750 also. And it is still in a long-term uptrend. So this was BASF, which did not work as faster as we expected. So nice cup and handle, goes below the cup and handle also, notice it. But it may not hit your stop losses, then goes higher. And then does the big move later on. So not all will work. So in this case, we got stopped out of because of time in terms of not follow up momentum for 2-3 weeks. So we got out. But then came the big 20% move. Another example where we expected the move to continue, we took half the position out here, the next one here because there was no follow up. But then suddenly out of nowhere, so this took our time stop losses and then went crazy. And crazy, I mean, it went from 500 to 800 in less than 2 weeks. So not all will work as you expected. The breakout was clean. Retest did not hit our stop losses. We got out here half the position and rest on the way down. Now, this was a clean position which worked really well. So this also came in our insider trading report. Promoters bought in March end, and the same promoters who were the group companies were selling in 2018, 19, 20 actually bought from the market. So that is where it came on our radar. Nice triangle breakout, good increasing volumes, but this was a slow and steady move. You got a target one. Then you gave another opportunity out here. So recently gave a big breakout, huge volumes, and now you ride the position. Now look at this one. Nice classical cup and handle, very huge volumes. So this is where you would believe, okay, everything is super. Just a little bit of a resistance around 45. Got in, got stopped out. So where would you get stopped out? So you got stopped out somewhere here in this period. Then we realized the stock got covered into. So in this case, we actually got lucky in terms of lucky as in we became smart. So this stock got covered in one of the business channels out here. And then it again got covered. So there is a lot of pump and dump happens. So in this case, we sold half the position. So we bought at 41, sold off at 44 levels, half the position, even though it was going towards a breakout, because the move was purely because of some khiladi call. And then that was the mistake. So it was not a, and then we realized when we looked at the bull deals, income tax department, which owns almost 12 to 15% of the equity, was a seller. So this is an ex-Malia group company. And that is where we realized, okay, the selling is not over. So this was a mistake trade in terms of you could have got out totally here or in hindsight. So you will make mistakes, but how much will you lose? You'll lose 5 to 10%, 15% worst case if you make the worst mistake. So net, this was an 8 to 10% loss for us. So this is a classical cup and handle in ICICI Lombard. Nice breakout. Only thing missing was volumes. But because it was a nice breakout, we said in cup and handles, I'm ready to forgive volumes because volumes could come later. But if the opportunity is 800 to 1300, that's like a 500 pointer, you want to get in. So in triangles, I can't leave volumes, but in cup and handles, I'm okay with volumes not being a big change. So in this case, broke out, stayed there for 4-5 days, then we got out, stopped out at 1300. So what did you lose? You bought at 1340, 1350, sold off at 1300. So you lose your 4%. That is fine. But if you keep holding it for the next 6 months, that is our mistake because the pattern has failed us and we should exit. Another example, Orient Cement, nice triangle breakout, 3x volumes, looked like a sloping cup and handle, just closed higher also. Everything seemed fine. The next few days it sustained also higher, so it looked okay, and then it flopped out. So you got stopped out at 68, 65. Got in at 70, 71, 72 something, got out at 68. So you lose 8%. But if you keep holding it till 55 and say if it goes to 45, that's our mistake. Because after 64, you have to exit because the last swing low has also taken off. So that is our mistake. We have to realize when trading small caps, you don't need to get married to an idea. Now, this is an example, Century Enka, nice range, then finally breaks out, huge volumes, 5x to 10x, super breakout, got in at 195, goes to 215, and then slow decline. And you say, okay, it is testing the breakout, holding on, then just breaks off. So you get stopped out here at 180. Now, this is even pre-COVID crisis. So this was not a COVID fall. It broke down even before the March fall happened. Now, so in this case, you get stopped out. If you keep holding it, say, suppose it fell in March, you can still accept, okay, it happened really fast, you could not exit. But this happened in February. So that is the mistake. So you don't know what could go wrong after the breakdown. So it fell very sharp. The swing lows are also out here. This is the March fall, which came a bit later. So now a few criteria which I try to look out for in terms of what sort of delivery volumes do I want on the breakout. So we've taken a lot of examples. So one part of it is I want to look at delivery volumes of more than 20% on the breakout. Why do I say so is if it is less than 20% delivery volumes, it implies that it is being pumped up by someone, or say there's a lot of speculation. So suppose I've already entered, then I would get off faster if the volumes are sub 20%. See, because on that day, you don't know what are the delivery volumes. And nowadays, because of a lot of punting in a lot of stocks, what we'll notice is we see a lot of such low delivery volume trades. So for example, in this case, there was just 20% delivery volumes out here. So I want to avoid, say, I'll take an example where we actually got into the breakout and then sold totally because it was being pumped up. So this was Aditya Birla Money, which got covered by a lot of, say, business channels. Stock breaks out, flops out, gets covered, and we exit. So this was like a pump and dump happening somewhere. Volumes were sub 20%. A classical example which happened was this single day, the stock moves up 20%. This is Amrutanjal. Out of nowhere, it gets covered on some channel. Stock opens up 20%. The volumes are huge. Huge means 3 lakh shares used to happen. And before that, generally 1 lakh shares, 2 lakh shares. On this day, there is 47 lakh shares of volume. This is almost 10-15% of equity. And after that, what happens to the stock? Goes nowhere. Then there were some companies where it got covered on some channel, opened on a 20% circuit, then 20% where people bought, and again gets covered here and then goes nowhere. So that's why we want to avoid companies where there are lower than 20% delivery volumes. Then there are some companies where the volumes are always low delivery volumes, which you can go and check. So if this company breaks out, every day it can't be same volumes. So this used to have sub 5% delivery volumes. One of the cases where we actually did a tweet in terms of avoiding. So this is Omax Limited. I'm not going to the websites and showing you sub 20% delivery volumes. We've actually done a YouTube video, which is there on YouTube. We've actually covered it in a lot of our tweets. So now look at this case, very high volumes and every day up. It doesn't matter where the markets are. And it's a real estate company. And then the stock falls really sharp. So sub 10% delivery volumes, we are totally scared. On the breakout, if it is sub 20%, I'll be very careful. I would like to get out on a short-term trade itself. So these are some thumb rules because low delivery volumes, because see, these are unknown companies. So it stinks of manipulation or I don't know what. and I would not like to go further into that topic. But the fact is, low delivery volumes, 5% delivery volumes, you totally avoid. And this continues. And now what happens is, because it has got covered on a business channel, the stock goes up 10-15% at 3:15 p.m. and then the stock gets dumped off the next day itself. So nowadays we actually track a lot of this stuff, because when we are trading small caps, we want actual investors. See, what we are wanting to do, we want to buy companies where actually somebody is taking a bet, a longer term bet, and we are going to make money out of his impact cost in the short term. We don't want to buy into some speculation which is being driven by some news, or say pumped up by some individuals. So that's the reason we want high delivery volumes. Now, this may not matter in a large cap because there is derivatives, etc. But in a small cap unknown company, you don't want low delivery volumes. So this is one criteria which we've started incorporating, because what happens is, in a lot of companies, there have been sudden moves at 3:15 p.m. and before that very nicely at 1:30 p.m., etc. So low delivery volumes, totally avoid. Most of the manipulated companies, so take an example. This stock was at the same price for almost 1 year. Videocon Industries. Doesn't matter what happens to the markets. Exactly the same price. And then comes out the problem. Same way, I think many years back I had written about Bhushan Steel. And very recently there was a company called Infibeam. Used to have very low delivery volumes on the way up. And then the whole problem happens. Basically, low delivery volumes is one. The next part is what I call as risk management in terms of riding the trend. So there are a few things which I try to look out for. Is basically, you would like to work in, say, sizes. So for example, for me it is 4% and 8% allocation. For somebody it could be 5% and 10%. How does this work is, many a times the stock has broken out at 100 rupees. But by the time I get, say, next day, for example, at times, or during the day also, the stock is at 106. My stop loss, which was 94, still remains 94. Now suddenly my theoretical stop loss, which I wanted to be 6%, has become more than 10%. But the breakout is clean. The target price is 130, 150, or 125 to 150. And it may not necessarily go down to 94. It may go to 100, 98. It may see an 8% dip. So in such cases, I'll cut my position. I'll take a 4-5% allocation, and then decide whether I want to buy on dips or only want to keep this allocation. Because who knows, it could just go away to 125 much faster. And in cases where I get it exactly around the breakout points, and say this could also be the allocation when we are not in a very clear time frame. Like right now in the BSE small cap, we are not in a higher top, higher bottom formation. We are in a sideways consolidation. So that's the time. So for September period where I would only trade on 4% allocations. I'll only trade on half the quantity. So suppose if I have 8% allocations, I will have 12 stocks. See, this can be thumb rules for everyone else. So this is a thumb rule which we run it for our technical traders club trade positions. So you can have your own thumb rules. Somebody would be fine with 2% allocation. Somebody will be fine with 20%. But this is the way where, and you're equally weighted. So you are not, say, overexposing to a single stock. So at times there could be one stock at 4% allocation, there could be 8%. But there will be no stock at 20%. So that is one big mistake which happens, which we've done before. So in short-term trading, what do you want to do? You want to stick to equal allocation because you don't know which one will move faster. So this is one way you can ride the trend and also be able to digest stop losses. When I say theoretical stop loss is 6%, but mal katte 10% ho gaya, liquidity, gap down, etc. Because you have, say, maximum 10% allocation, it falls 10%, you lose 1% of capital. So that is fine. And when you have that sort of allocations, you are fine with it, because you can sleep over stocks, you can digest the 10 days of volatility after the breakout. But if you take 30% allocation to a single stock, then you see stock moving up from 110 to 100 in that 10 days, then you will be out of the swing and you will not be able to ride it. Then riding the position could be similar. You have 8% position already taken. You can cut half the position at the first swing targets, as in the smaller triangle handle targets, and ride the next of it. And if you're convinced, ride the whole position. And you can keep riding it till the time the stock is doing really well. So, and the last part in this case would be what? The last part in this would be when not to trade. If you can do that, the whole process is over. So this is where I end my session. We'll go to the Q&A. You can put it on the Q&A box. Just give me a minute. I'll have a little water. Yeah, so we can take Q&A on the Q&A box. So we'll take the first question. Relative strength in small cap also means there is divergence between large cap and small cap indices. How do you interpret that? If Nifty is going down, but small cap is flat, does that mean small cap is strong and is likely to continue to go up? Hence the small cap is likely. So what we want to do is, like in 2015-16, Nifty was flat, Nifty was down, small cap was flat. Now we will not participate in all small caps. We'll participate in small caps which are taking leadership. So textiles and chemicals. Say for example, May-June period, Nifty has not reversed very strongly. But if you look at it, pharma index had made a new all-time high. So that is where you want to look at pharmas. So that was the answer. How do you come up with an initial screener to stock you want to study? I would suggest everyone to pause on the questions. So I'll take one by one. We have enough time. So let us first take few questions which are already there. Then you can put in your questions, keep it typed, and then put the timestamp. So it will be easier for me. Okay. How do you come up with an initial stock screener to what you want to study? So basically, see, we are full-time into the market. So we actually, for me personally and Harsh and our team, we actually look at all 1500 stocks on a daily basis. And by the eye. So there are two ways. You can do it by the eye, or you can do it via screeners. So you can create stock filters in terms of range bound, stocks closer to 52-week highs. And every week you can study 100 stocks, make a list of 20 which are doing a cup and handle or a triangle, and then create price alerts and keep them. So for example, this is what happens for us on a daily basis. So now this is what we do on a daily basis. So I make a list. This goes into our team. So this also goes to our online course participants. Those who have, you can always go through our online courses where all of these are discussed. There is another session, Analyze with me. So I make a stock list. It goes to my team and as well as to the online course and Analyze with me participants. So what happens is, this is how we filter. We look at all stocks on a daily basis. Now, when the trend is up, we have to look at 1200, 1500 stocks. When the trend is down, it does not matter. Why? Because you only have to look at the 200 stocks where you can go short also. So you're just looking at 100 stocks. So you don't want to look at the whole universe. So when the trend is up, like say June to May, June to current periods, you look at all the 1500 stocks. See, for us, the whole universe is there. You can create your own universe of 200 stocks, 500 small caps, or 150 small caps, which you want to trade. For example, there are so many very illiquid small caps, you can just remove it. So you can create your own screeners. Say during the day, for example, there are a lot of screeners on charting, trend line, volume shockers, which tell you stocks. So on money control, volume shockers There is always a list wherever there has been a 50% jump in the volumes during the day itself. So you can track those stocks. So there are a lot of filters which are available on various platforms. So for example, you can keep looking at day highs and day lows, which are happening through Edelweiss app or Falcon, Reliable, etc. So that is how I filter. We look at a lot of stocks. We keep looking at what is happening during the day as to what stocks are the top gainers today. So that's how the filter comes in. So that is how our filters are. So this is an example as to how we have notes on a daily basis. So for example, if I tell you Pokarna, this is on a radar. So this is how it would be, right? This is a cup and handle in the making, but it is still far away. So the price alert has been put at 155. This is not a recommendation, but this is how we screen for stocks. There is absolutely no reason to buy today, but we may buy at 155. So that's how it will go into our, say, radar. So that's how we keep making notes on a daily basis. So this was just to explain how daily basis happens. So this is what so for example, the Analyze With Me session, which I do, we actually analyze stock the way we filter. So I hope screening part is done. Let me go one by one to the questions. What to do with long-term stocks? Do we have to book profit? So see, here we are looking at the shorter term trends. Long-term stocks, you have to ask what was your reason for the stock to buy. If you just bought randomly, then you decide for yourself. But if you've entered on, say, a fundamental logic, then wait for the fundamental logic to change. If you've bought it on technical logic, let it stick on technicals. So the view is till the time the trend is growth, you hold on to stocks. Keep booking partial profits. Take a cash call. See, the first part of the session is where you take a cash call. And that will help you really a lot if you can do it. You just look at BSE small cap and the Nifty. Decide your cash allocation in that. You could even decide on mutual funds. Then we go to great session. Do you look at multiple time frame analysis or only daily charts? So I look at only daily charts. But if I look at it a 5-year period, I'm looking at multiple time frame, right? So this is where there is a lot of problem when, say, people look at, call it confusing in terms of I look at weekly time frame, monthly time frame. The fact is, by default, most software show you only 1 to 2 years of data. But if I'm looking at a daily chart for 10 years, I'm looking at a 10-year time frame, right? So it depends how you want to look at the chart. I prefer daily charts. Even on an unzoomed panel, I look at the daily charts. So it is not multiple time frame, it is longer term time frame, which we want to look at. So the number of candles reduce. The open high low closes of the same day would be the same if you look at daily or weekly. I prefer daily charts, and I prefer to first look at the last 6 to 12 months data. If something I like on the last 6 month charts, then maybe I will like it at a 6-year chart. It would not be the other way around. I'll take the next question after that. How to place stop loss or triangle pattern and CNH pattern? Like I said, you can take the last swing low or you can take the 10-day, 20-day moving average, whichever you prefer. So for us, it is generally the 18 or a 20-day moving average. And then a little bit of modifications, which we do a bit, but a random thing. But moving averages are a good stop loss. When we have entered a stock at an all-time high, what must be the target? You just have to ride on to the stock if it's a cup and handle pattern. So that is where it goes further into what sort of a pattern it was. But all-time highs are good. You ride the position. With reference to chart pattern, is there a minimum number of trading sessions? 1 second. Is there a minimum number of trading sessions before you can call it a valid triangle or a cup and handle? There is no minimum or no maximum. It is again observational. So we don't. So in terms of breakout, I want to buy it on that same day itself or the next day max. I don't want to wait because stocks can go really, really fast. So for example, a few days back, I think last week, we saw Thyrocare as a breakout, and by the time we could actually think and enter, the stock was up another 5%, and it hit 20% the same day, another 20% the next day. So we want to get in right away. So there is no time frame in terms of minimum bars, etc. We want to buy it when it breaks out. We are ready to take that 8-10% risk all the time. Did the trend line break out yesterday in lower time frame, but in daily it closed below the trend line? So in this case, you will get stopped out. Say, for example, if I'm looking at JK Lakshmi or JK Cement, I think, which you're talking about. So in this case, suppose you bought this breakout, the volumes were not great, we were tracking this, and then it closes lower. Doesn't matter if your stop loss is placed at, say, some low or some moving average here. You wait for it. Doesn't matter what happens the next day. I've said it a few times in the session that the next day could be weird, the next day could be higher also. So you keep your stop losses and you wait. So while filtering, do technical filters, do you see whether fundamentals are stable or is it only technical based? Yeah, we look at fundamentals to understand, so in a lot of cases, it's a mix in terms of most of the times we want to like fundamentals and then a technical breakout. And this was, so like for example, I discussed about how we look at insider trading. So we look at a lot of things, but price action is what really gives you the advantage in terms of timing. If possible, can you explain Loris Lab chart? So we actually, this was one of our biggest mistakes of not catching in. There was a clear cut what we look out for an exit of a PE and etc. This was out here, the first block deal happened. And this is where it broke out into all-time highs, nice range-bound movements, multiple times it gave you. So there were multiple opportunities to get in, but somehow we missed out on it. Because this is where it broke out, then the bull deal happened. Then there were a lot of tight range movements and another deal was left. So after this deal, crossing this high was the first indication. So the total selling is over and this was the buy. So this is where you should have bought. But somehow it missed us because we missed it at 440, then it became tougher. So it was a bias which stopped us from buying into it. So this was one of our mistakes because we were tracking it and we missed it. And we don't want to say, explain, there's no explanation. You miss it, you miss it. Any website from where we can download EMA values for, I would suggest take a end of day software and then you can download Excel in it for most stocks. So you can do it easier with end of day data available rather than from the website. You can create more filters on any software. How to increase chart reading speed? So I think that would require a lot more analysis. I think that is where I actually do analyze with me sessions where we go through 200, 500 charts and try to increase speed. But I'll give you one hint, which is do not try to make a view on every stock because you only want to reject companies, right? So if you're looking at 1500, going to buy 10 stocks, your job is to reject 99.5%. So don't try to make a view on all the stocks. If you remember this line, it will increase your speed. When I observe charts and so I'll take this question, when I observe charts and decided to enter my conviction saying it will go up, but when I open the counter, big spread and low participation, so thinking and immediately it started to this way I'm missing. So like I said, you are trying to overdo the thinking. If the stock has broken out, you are going diversified and then you just wait for the stock to do what it wants to do. And if you do it over multiple stocks, net, if you go 4 to 7 times right, and if your risk reward is in place, you'll make money. But what happens is because we go gung-ho on a single stock and you get scared a lot. So you have to have some basic risk management and stick to that. So in this case, when you're talking about IG Petro, that is where you would have missed out. There were good volumes in that stock. But if you start looking at very intricacies, see, the fact is everyone wants to increase the hit ratio. The money is not made by increasing the hit ratio. The money is made by getting one big trade right. So because stop losses are always going to be 5-10%, but one hit trade of 35% implies you have between 4 to 7 stop losses to be digested. So that is what you focus on. Do delivery percentage also matters? Yes, extremely in case of, say, avoiding stocks. It does not matter in terms of breakouts a lot. So we don't have a criteria. It should be 60% delivery volumes or 30% delivery volumes. but we don't want sub 20% because that is more speculation than some actual individual buying in a big way. So that is stop losses, moving average basis, or latest swing low. So that is very dependent on your style. So we prefer a mix of both depending on situations, but you can have either of them. So many a times you look at the market conditions also at times to decide. We will not be sharing a recording of this because we don't want it to go into the public forum as such. We've actually done this webinar only for the participants who are there on our WhatsApp list. We've actually not sent it on any of the social media channels as such. So we want to do it selective. This video will be added in the online technical analysis training program as a additional part. So it will be available to people, those who attend the online session. So what we are doing is we are also creating a library of say good say discussions, etc. So that goes into our online session. So it reduces a lot of my efforts in terms of training. So we take up as many topics. We've already have 15 hours of data over there, but this way there will be some more which is adding up over there. So there is no ideal delivery percentage to look out for. The only thing is non-ideal part we want to remove. कि जहाँ पे manipulation हो रहा है, जहाँ पे there is some pumping and dumping, 5% delivery volumes, so I just want to avoid those companies because that is where I can lose 100% of capital. When we seeing the stock pattern formation, is going on its, I think there is some circuit word, so I need to read this specifically. Is going on, and suddenly it was upper circuit. Next day when we try to enter, also it is 27, which not allowing to. So this is like I said. So you miss some, you can't help it. So for example, if it goes beyond my risk reward, I'll have to give it a miss. So in this case, you're talking about a stock. We don't need to catch them. You have to give it a miss. So I missed out on Thyrocare. Fine, I can't help it. I can't change it, right? So in the same way, if you've missed it, you missed it. You don't need to catch every moving stock. You go find the next one. How to identify that sector is performing well, like pharma, it did better than last 6 months. So for example, we've discussed about pharma in one of our videos in terms of, and in the website also, we've discussed about relative strength. Equivweight indices is something which we do. So we create equivweight indices for a lot of sectors. And we've actually shown that in one of our say course videos where and recently we've also spoken about how IT was a breakout. I think we did a lengthy post on the website also, and we spoke about how TCS was breaking out about 2300, 2350. So you look at relative strength on sectors, and we do write sectoral posts also for the same reason. I think right in May, June, we talked about sectoral rotation and how autos were showing relative strength. So I think you can go through some of the older articles on the website. You'll get some idea on that part. And maybe someday we may even do a webinar on that topic because that's a very interesting topic. So how to figure out hot sector at any point of time. So that is a lot of relative strength studies, etc., which goes. So that's a topic in itself. So I think I would not be able to answer in a few minutes. So we look at sectoral indices and equivweight indices, and then stocks in a sector. So we have a nice, say, part of that session, which is there in the online course, which we've actually tried to formulate it in a better way. What is the best exit strategy for a breakout position? There is no best exit strategy. As I said, I want to focus on the exits where I can ride more. My simple stop losses on moving average or swing low is the best one. See, because the mistakes do not, we always worry about 8% losses. We don't focus on making a 30% trade or a 60% trade. So that is where we have to focus on how to catch. So my biggest mistake is not the loss making ones. My biggest mistake is not being able to catch a Loris lab, right? Even though when you're tracking it. So that is the top of my mistake list. Next, please analyze MMTC. I would not like to analyze MMTC as such because it's a very, very illiquid counter. So these are the kind of trends I don't want to participate in. So no views on MMTC as such. Most often, after getting stopped out, stocks move up. This hurts a lot. This keeps us holding even when it comes down. So, see, this is where you have to be non-emotional about losses. Like I said, what hurts you is where you lose money. What doesn't hurt you is the fact is you were tracking Thyrocare and the stock went up 30% in 2 days. I was tracking Himmat Singha and went up 40%. So what should hurt me? 8% loss or 40% loss? Essentially, this was 40% of loss on possible profit. So if you start thinking on those lines, you'll be able to digest losses much more. So the fact is you stick to your system. See, because your stop losses are not to save you from, say, a false break. It is to save you from sometimes when it goes terribly wrong. So start thinking differently and the performance will start improving. So do not look at, see, what hurts is you have a stock you cut out at 8% loss and then it goes up 50%. Absolutely, it will hurt you. But why does it not hurt a stock which goes up 50% and you are not able to catch it even though when you're tracking it? So, and even why were you not tracking it? So that is what should hurt you most. Because 140% trade takes care of at least 5 bad trades. So this is what, say, after 10, 15 years in the markets, this is one of the major learnings which I've got is we do not focus on how to ride big when you go right. And we just don't worry about something we missed. We only worry about our losses. So let me take the next question. So there is no solution for your this thing. The fact is you have to be very practical and accept the mistakes and go on. Any good screener applications where you can put filters? I think there is charting. There are so many. Stock Edge has a lot of filters. A lot of apps have a lot of filters. You have to decide your style. Say, I have become more comfortable of my style in terms of looking at the screen, looking at the charts in the evening. So you have to find your style of screening. Do you exit on targets or prefer trailing? So we try to have this situation where we cut half the position on targets and then trail the rest. Do you have a session to help us how to find out swing highs and swing lows? Absolutely not. We can't find the exact highs and high lows. So we want to get into the trend. So we don't prefer to find exact swing lows because that is extremely tough. RBL Bank currently broken out. So, for example, one of the reasons I've not been looking at banking stocks is they are not leaders anymore. So one way of rejection was I don't want to look at a lot of banking stocks. And I think I've written a few times in my website. So a lot of banking stocks have been giving false moves. So you want to participate in places where there is strength in the sector also. So I think the fact is banking is no more the leader. So you will see false breakouts in. And I actually wrote an article on the same thing when Kotak was breaking down. I think, or say breaking out. So RBL Bank was the same case. Where to book profits, sir? Please answer this. We are able to enter right, but missing out on the exit. So as I said, the calculation of the target is what? So like I have explained in a triangle, exit targets are very clear. So if the triangle is from 100 to 140, the smaller range is say 20 points, you get out at 20 points, half your position. So this is the way we look at target prices. So for example, if I were to go in this particular trade where we did not get conviction on the markets as such, was Supreme Petro. So in this case, we got out at the handle targets itself at 230 because there was not conviction in the markets as such. So we got out here itself. So what do you do? And we first cut off half the position, then cut off other half of the position. So you have to decide. So in Natco Pharma, we got out a bit too early, but that's all right. But we got our somewhere closer to a 15% trade here. So take your targets to be on the charts in terms of the ranges which come out of triangle patterns or cup and handle. So get out at those prices. So one of the strategies which we do is we cut half the position if the movement is not very strong. So let me take some more questions. So I'll start from the lowest. Can you analyze Marksans Pharma? So for example, Marksans is on our radar. Why should it be on our radar? Because it's made quite a few tops here and the trend is still up. And this is the problem zone ever since the last 2 years. So it's been on our radar. We are waiting for some more consolidation because here my stop losses are a little deep if I have to enter right now. So my stops are coming at 10-12%. So we'll wait for some consolidation. And if it does not fit our stop losses, I will give it a skip. What will be the ideal moving average that we need to track? So as I said, we actually have a list of moving averages which we say according to the holding periods. So you have to decide a moving average stop loss as per your holding period. Pal Pharma is an interesting chart, but again, it's a very liquid one. One more, please, specifically 8K miles chart. Absolutely, I will not look at that chart. We've actually discussed about it as being a crazy company back a few years back, and we had our warnings on it. The stock went up 7x and then fell 80%. So that was the fact. We are entering stocks at the right time. So I think we've taken that. Analyze NIIT Limited. I don't want to analyze a lot of stocks because we don't want to create, say, this is not a session where we want to give you stock recommendations or something. There's a lot of compliance if we do that. Which is the best, buying on the day of breakouts or buying in the pullbacks? So this is where my personal view is I like to buy breakouts. I don't want to buy pullbacks in small caps. I would prefer buying pullbacks in large caps. So for an example, which we discussed on the blog also, was TCS and say a Dr. Reddy, for example. I would like to buy a retest. I am not able to open that data for some reason, but I would buy pullbacks in large caps, not in small caps. Because that is where it's a bit tricky, because if the stops get out, the fall is really sharp and then you are not able to act. So I would prefer buying a TCS pullback which came back to 2300, Dr. Reddy which came back to 4300, 4200. So I prefer pullbacks in large caps, mid caps, not in small caps. In small caps, because the moves are really fast and ideally I want stocks to move out really fast when I buy a small cap. So I don't want to buy Bansali Engineering is coming out of range your view. Yes, we were looking at it, we missed out. So it has already moved out a lot, so we won't buy right now. Risk reward is not in favor. I'm having difficulty in stock selection process. As you said, there are so many stocks. What should I do? So as I said, have few filters in terms of your style. So like I spoke about 2 patterns, and we try to focus a lot more in these 2 patterns only. Metropolis, again, like I said, we are looking at that space. Risk reward is a problem. So to just make it simple, I'll take Metropolis chart and say, into it as to what happens. This was the day it breaks out, right? So if I'm buying at 2100, right? The breakout is about 2040. I'm buying at 2050, 2100. And if I keep the 18-day or the 20-day stop loss, it comes to 1860. So that's like 200 points or more. So that's like a 10% stop loss. I generally don't prefer 10% stop losses. So one of the ways which I reject a lot of stocks is I don't want more than 10% stop losses. I have to be extremely convinced of that idea, or there has to be some other reason. Say the sector is doing really well, etc. Volumes, delivery volumes are great. So in this case, the volumes are low, delivery volumes were lower relatively for Metropolis. So we rejected the idea for the same reason. So we would have preferred a Thyrocare, but it went out really fast. Why Thyrocare? Because there was the range consolidation and there was a triangle breakout. So here the stop losses were digestible. So in a lot of cases, we can reject a lot of stocks where digestible stop losses are not there. At price coming out of the pattern during the day, by end of the day, it ends as a shooting star. Should we stay in the trade? So I don't try to, once I've entered, we don't look at candlestick patterns for small caps. We look at the major chart patterns only. If you look at candlestick patterns, then your decision, as I said, after the breakout, it can again come back into the range. So which has happened in a few stocks. So I would not decide on the day's candle. I would let the stock do what it wants to do and my stop losses should be in place. What is the minimum circuit filter that you look for in stocks and would buy something which has only a 5%? So there is no rule in terms of a 5% circuit level. So we've bought stocks which are up 12% also, which are up 3% also. So there is no rule per stock. The rule is from the chart. Is it possible to screen stocks on basis of cup and handle format? Yes, you can create your own filters as such. Like I said, we like to see it by the eye. And we can keep looking at those stocks. Please have a look at Vimta Labs disclosure. So we have an open recommendation there. So we like the stock. The stock looks interesting on the chart patterns. And this was a case which where we took half the position only because this is where it broke out. This was the triangle pattern where it broke out. But we are a little late to get in here. So we continue to, so we like the stock fundamentally. So this is where the retest is. The only reason we are not participating right now is it's because in T2T. So the next time it breaks out above this, that is where it would be interesting. So we like it because of the volumes and the price action in terms of fundamentals. SMA is better than EMA. That's your call. I like EMAs. So, and the difference is not very large, to be very frank. So if you see 200-day moving average for Nifty, it would be say 50 points or 100 points away. We look at moving averages in a different concept, and that's why we look at exponential moving averages. Please suggest good books on classical chart patterns, price action, and volume. So as I said, I would rather suggest my online course, which is more example based, rather than looking at a lot of books. One of the reasons books become a problem is because none of the books are really written in the context of Indian markets or in the recent time frames. For example, moving average crossovers are not important today. Why do we still use a 200-day moving average? 50 years back or 30 years back when moving averages came into the picture, it used to be 200 trading days in a year. Now we have 240. So I would suggest learn from experiences of people, learn from people, those who post on various media, and learn through examples, learn through trading rather than trading. One basic book on technicals is enough. One basic course on technicals is enough. But after that, you don't need. So for example, I do a 15-hour course where I cover almost everything. And after that, you don't need books. You need practical experience. And that is your personal journey towards becoming a better trader. Nobody can help you in terms of putting all of them together. There are 4 MAs on your charts, which are those. Ideally, I don't prefer to share my moving average charts, but this is the default template. So we do a lot more on moving average convergences. It's not about the 4 MAs. How do we use those 4 MAs is very important. So there's a topic called convergences of moving averages. And one of the reasons we don't put a lot of moving average charts is because we have something very nicely and practically which works on moving averages. So, and that's why if you see my website also does not have a moving average chart. It only has clean charts because moving averages, the way it has to be used is very different. We don't use moving averages for crossovers or supports or resistances. We use it for either as stop losses or either finding big moves. So just while somebody is asking, I would prefer not to take a lot of stock ideas or this thing. So Just Dial is one more stock which we don't track a lot because it used to be very low delivery volumes. So this is where it broke out yesterday. Price volumes were great, but somehow this is a stock which used to have very old delivery volume, so it has gone out of our radar list for some time. So yes, it's a breakout yesterday, but now I will not be able to participate. So I would like to participate here in the middle itself. So what I prefer is either I should be able to participate here, or I should be very, very convinced to buy here, and I'll buy only half the position. Which does your course cover the moving average concepts? Yes. So just a plug in terms of what we do. So I have two courses. I've been doing technical analysis training programs on a weekend for the last maybe 10 years. And we used to do it on a Saturday, Sunday in Mumbai and in various other cities. Post I got married, I started doing it only in Mumbai. Since then, over the years, we've reduced the number of courses. But post, we just actually did a full online course before the COVID crisis. And that's where I became more comfortable. So we've created an online video course which has 15 hours of data, which has convergence of moving averages as a full topic. So there are various topics neatly covered in terms of examples, etc. Once you've done the course, we have a query session where we try to analyze a lot of stocks and how a normal workflow goes for me. Once you've done that, Analyze with Me is a course where if you already know technicals or you've done the course, where we do practical analysis. So we take a 2-hour session every Wednesday and one of the sessions on a Sunday. We try to analyze the markets as and when we are. So where, for example, if I'm making this stock list, how is it made? How are we looking at charts? How are we seeing, creating lists in front of us? So for example, I'll keep tracking a OFSS, even though it is very, very far from a breakout. Or say a Mahindra CIE, which may no more be very close to a cup and handle, but it's a nice triangle consolidation. We keep watching. Does not imply we may buy, we may not buy, etc. Promoters have bought here. We'll wait for price action. So this way, where we look at such charts, how to create list, how to follow list. So that goes in terms of practicals part in the Analyze with Me session. So there we do it roughly 5 sessions where it's an open Q&A. It happens on this Zoho platform only. The only difference in that is we actually use a tool where if somebody asks, raises hand, we can actually allow them to talk. So I think if somebody out here has done, so I think we'll give a chance to Ram to speak. I think it was done by default in terms of happening. So what we do in that case is we actually have a discussion where somebody can ask their topics, and it's for a batch of less than 20 people, roughly 10 people, 12 people in a batch. But the fact is, what you have to understand is, I may do a course, you would have done a course somewhere else. The fact is, after that, you have to learn on your own, become practical, focus more on risk management. I've taken this so there's a lot of effort which has gone into creating this presentation to make it more presentable, because the charts which I send even in our advisory services during the day when it is breaking out. So for example, so I'll show you a chart which we actually send. So for example, if I'm say some of the trades, if we have taken one of the charts which we've covered here. So if I'm taking a chart, this is how it will go to the clients. It will be a much more simpler chart. So this is OMDC. So this is how a chart will go to clients in terms of a service which we run. We may not put that many arrows, etc. It's a very simple. So this is something if we've caught it in the day itself. So this is an example as to how it works, where we look at end of day data and price action about 1700, which triggers us. So we may not put this many, say, explanations when we are actually trading. So that is how it works in terms of how we do it. I would suggest go through the website in terms of older articles, go through all the details which are there. If you have any problems, you can WhatsApp us. And we try to cover a lot of such topics even on the blog. There's a free ebook on the website itself, so that will give you a good hint in terms of how to look at technicals. So if you go through that book, I think that book I have written quite some time back, but it is still relevant. And when I'm talking about this triangle pattern, it is actually explained in much more details here. But people don't want to take that effort in terms of reading. So when I talk about triangles, so I've actually covered this as a more theoretical approach also out here. So a lot of learning is available free in this particular book itself, channels and various topics. So when I'm talking about this, I've explained this in much more details here. But what I've noticed is one doesn't. So this is exactly a copybook like it is in a. So I tried writing a book in terms of purely a theoretical book with all the points as you would like in a book. And that's the reason I didn't publish it. I put it as a free book. If you want a very academic explanation of triangles, it is there here. I've tried to explain it with examples. If you want it in this way, it is there in the website. So we keep explaining a lot of topics because explaining it makes us better in terms of our own performance over a period of time. And this is the only thing which I love to do. So for me, it is all about market. So the webinars also is a way to help me get better. The Analyze with Me session is also to help me get better. And luckily, I get paid for it. So more the merrier, so it does not become a problem. So if you have any questions, we can put up right now. Otherwise, we'll end the session. And if somebody has a lengthy question, we can take a 3-4 of them on the, say, if somebody wants to talk about the session, particular topic where you have a question where you need to explain or something, you can raise your hand or you can put it on the Q&A box. So let us try this. We'll let Srijit ask a question. Yes, Srijit, you can ask a question.
Yes, sir. Good evening, sir. Very good session, actually. Sir, I had one doubt. Actually, I was trying to build a portfolio. Then I was always confused. What should my allocation? Like long term, I should have a major chunk of my investment should go to a long term, so that I do not worry day-to-day movements. And then, is it better to have a small 20% to 30% of fund, which I can directly invest in short-term trading, targeting around 20 to 30%? What should my approach? That's why I was just confused about that.
So see,
short-term, you can see 20 to 30% you will easily get if you select good stocks.
See, the problem is long term and short term is a very tricky question. For example, things are changing much faster. And say, see, it's not about whether you are holding. See, if you have holding power, does not make you a long term investor. The fact is, do you understand markets? Do you understand the stocks? Say, for example, you're doing fundamental analysis. A lot of companies were great 3 years back, and you've been hit in some of them. Things change. COVID comes out of nowhere. So the fact is, whether you understand businesses, then you can be a long-term investor. If you don't understand anything, Just because you can have money and you can hold it for 3 years does not make you a great long-term investor. So
Correct.
either you study technicals, you study fundamentals, or you have some asset management rules, asset allocation, where you want to have it. So you can have a mutual fund portfolio which is long term, right? Leave it to a fund manager, or you can have an index fund. You can buy a say a Nifty Next 50, Nifty Junior, and the Nifty 50 ETF, and have asset allocation rules. For example, one of the classical ways which I tell most people who don't want to do anything: take a Nifty Next 50 and a Nifty 50 fund, split your money in both of them. Say 80-90% of the money goes there, put 10% in micro caps, small caps, on whatever reasons you want to. And whenever you see a BSE small cap and a Nifty divergence, increase cash. Whenever you see RSI divergences on the Nifty, increase equity. So if you can use only those 3-4 rules, fair enough. Or you have asset allocation rules. If my portfolio increases by this factor, I'll go back to bonds. But just because we have money and we can put it for 5 years does not make us a long-term investor. You should have some rules on which you're investing. So in the same way, if you're trading, you better have some logic. So this whole session was to create a process you have for trading on the short term on mid caps and small caps. And that is why we make all the mistakes. Just because we have cash and a checkbook, we start investing.
Yeah.
And you'll have good and bad times. So for example, I'm a small cap investor. 2000 to 18 to 20 has been terrible. So we've got some of the worst names in our portfolio. But that is what happened with us in 2011 to 13 for 2-3 years. But then 14 to 17, in a single year, we are up 120%. So that is how cycles are. So you can't expect, most people want drawdown of 10-20%, but a good year of 120%. Not going to happen. So you have to have some rules or some learnings, or stick to simple rules of index fund, mutual funds, and asset allocation.
Correct. Sir, one more doubt, sir. Is it happened to you that you are convinced in some stock, and so that you have put a stop loss, but you are still feeling that okay, stop loss I will just remove because I had a good conviction on that, and you
Absolutely.
just
Has,
hold on to
has
that and
happened.
come down.
Happens with everyone. I'm not going to be right all the time. Right. So I've made some of the biggest mistakes in 2018 to 20. But that is how it works. So I've made some of the biggest money also in 2014 to 17. So you'll not be right all the time. You have to accept it that you're not God and you are not going to be right all the time. Be humble or get humiliated. So that's the rule in the markets. So either you be humble or you'll be humiliated by the markets because you are human. So I'll discuss about asset allocation. So when we do BSE small cap and the divergence. So one of my mentors whom I have learned a lot from, he said market ni used to explain market ni kamai, market ma samai. So when you have a great time, you need to pull the money out of equities and put it into a fixed asset, or you put it into bond funds. Put it in a fixed asset where you cannot remove. Because see, in a bull market, you will make mistakes. You will get influenced. You'll get married to stocks. So for example, in 2017, even if you pull out 20% of the cash which you were in equities, it will save you in 2020. So that was the biggest learning. So for example, you buy real estate in 2017. So I bought real estate for the first time in 2017, a second time once in 2015, but actually a place to stay in 2017. And that has helped me in the current cycle. So you have to have some basic such thumb rules in terms of when you have to pull out money, when you have to pull in money, because everyone will make mistakes. You will not get, say, if you have 15 years in the market, you'll not be right all 15 years. You'll be wrong 3 years, 2 years, 6 months. So whatever be your time frame, you're not going to be right all the time. So accept it, learn from it, because see, if you're going to be in the markets for longer period of times, your, say, compounding will keep helping you over a period of time, even if you make mistakes. So till the time you are not losing 100% of your capital, or even say you will lose 50-70% of your capital, even if you're a long-term, very bad investor, if eventually the economy grows, you'll also make money. The worst case which could happen. So I know a lot of investors who missed out, who got stuck in 1992, forgot the stocks, and have multi-baggers in 2005. So luck can play in various ways, but accept the fact that you will make mistakes and you want to learn from them. You will see people only talking about when they are right. So we are going to be wrong more often than not. So that's why I also talk about the failures. And many of my failures are anyways known publicly because we don't hide it. So except you will go wrong.
Okay. Yeah. Thank you. Thanks a lot, sir. Yeah.
Yeah. So I think I'll pass on the mic to someone else also. I think Brahma, you can speak. Okay. Anyone wants to speak, or I'll just I'll take the Q&A which is there on the. Let me take this questions out here. Thank you, sir. If we book the profit when the target is met, then won't we miss riding stocks like Aarti Drugs? Absolutely. That's why I said book half the positions, but these are all short-term trades. So we've looked at longer term. So this was purely how to trade small caps and mid caps. So it was about trading them really short. So that's why I said in the long term. So we've looked at various companies before, Bharat Rasayan, etc., which we've discussed. So there is no way, say, and that's the reason if you keep on holding on to the stocks. So I think there are two questions from you. If you have a stop loss on every trade, then our system will put us into cash before an event like 2008 or 2020. In the same way, if you have very small stop losses, you will not be able to ride a Aarti Drugs or many other stocks. So one has to find an asset allocation match. So that's why I said in 2017 and 18, you can't be 100% out of small caps. So if you pull out cash in 2017, deploy new money in 2020, that is how we should be able to do it. So if we only do trading on the buy side, where do we trade in times when you say we shouldn't participate in mid cap? So that is the time you trade 30% of your size. See, because it is extremely difficult to be an equity investor and be on 100% cash. So you cut down your size. So that's why I said what we want to do is we want to increase cash whenever there is a BSE small cap and a Nifty divergence, because it is extremely difficult to be going on 100% cash. And what if you go wrong? So you thought markets have overrun in May 2020 because COVID has a super impact, right? And you go wrong. What do? Now you're out 100% cash. Then when do you get in? Right? So for a long-term investor, it is extremely difficult to go on 100% cash, but you can go to 20, 30, 40% cash whenever you see the indications. For example, in demonetization, you thought, boss, everything will go bad. People will go bad, etc., etc. And then you are the cleanest year. So what you do is, whenever there is froth, increase cash. Whenever there is pessimism, deploy cash. And this is what you have to do. You have to decide when to put in cash, when to remove in cash. And if you're a pure trader, only a trader with a very short-term time frame of few weeks and few months, then you keep your stop losses. In that case, you should be out in any event like 2008, 2020, or even a 2016. So in that case, you have a very strict stop loss. So for example, if you are derivatives, if you're a derivative trader, you can't see a 30% fall, because even if you have 2x leverage and you see a 30% drawdown, 60% of your capital is gone. So that is how you look at it. Do you look at the chart of commodity as well as and then compare with companies dealing with it? Yes, we do look at it, and I think we did a detailed video in terms of sectoral analysis on JSW Steel when it was at 200, 220 levels, and also on Tata Steel when the previous move happened. And currently also we've put how it is at a retest. They say options are also multi-baggers on daily basis. Do you trade in FNO also? We do trade, but you don't get multi-baggers on a daily basis. So if you get multi-baggers on a daily basis, then you should be richer than most people around you. So what can happen, what happens in the market and what you can do is very, very different. Because in hindsight, you can say, okay, boss, aaj to lagta tha Nifty chal jayega, and you could have bought the 11,900 call and made 10 times money. But in the end, it is all about risk management, because whatever strategies you use, you have to use it in terms of that you don't get killed in the markets. So if you do not understand leverage, you should not trade FNO. Like I said, if you have 3x leverage and you get a 30% 10% drawdown, 30% capital is gone. You get 30% drawdown, your full capital is gone. And then you can't trade also. Do you use any indicators or purely price action, patterns and volumes? In small caps, no indicators, zero indicators, only price action, volumes, delivery volumes, maybe fundamentals, maybe insider trading, but no indicators. Indicators only on indices and say maybe some stocks. While trading in mid caps these days, do you tie your decisions to the Nifty moves or no? We take a structural view in terms of where the trend is. So like we are making higher tops and higher bottoms, we are not making right now. So we've cut down size and say if we are not showing strong momentum, we may cut down existing positions also. So this is a mistake which we used to do before, not accepting the trend at times. So cut down position, cut down size. So if the Nifty breaks down, cut down size, even if the small caps have not broken down. So we use a mixture of everything. That's why the first part of the session I explained, when do you want to trade maximum? When do you want to avoid? And so 2018 to 20 was a mistake. Nifty was up. This was the first time in 15 years where Nifty went up and small caps went down terribly. So you learn from the markets. So we had a terrible 2018-19. You learn from it, because whatever thumb rules which you were using and which worked for 12-15 years did not work. So we did not start going back in April. We went back in May end to June. So for example, so this was the time where it became clear in terms of getting back into the markets. So this is Nifty breaking out. And this is the time where small cap index broke out. The triangle consolidation pattern which we spoke about, and then it also crossed the recent swing highs. So that is where we started trading back in small caps aggressively. So it was May end to June. You can't catch the absolute bottom. So I think this explains the triangle pattern also, and also how it worked out here. Tight range, indication of the base forming. So this is the point of time where you realize right now, this is where we are. We are stuck on the small caps. So what do? Cut size. Wait for it to make a tight range, break out, then we'll see. Like it did here. That was your another time to get in. Now is not the time where you are very clear. I hope that answers your question. Can you analyze Atul? So I would not like to analyze particular stocks, but Atul has been one of our favorites over the years. So I will. This is Atul. If you look at it, this is where it broke out recently and did a nice steady move. And this has been a classical stock in terms of triangles and cup and handles. So we've been participating in this company right from 460s, and this has been the only company where I've never made a loss in a trade. So it's one of my favorites. And we've taken this example. So this was where we took it in 2014-15 as an example. So if someday VIX is high, all our stop losses will be hit, right? So it does not matter if VIX is high. It could be when VIX is only high when there is a major quick fall, like what happened in March 2020. So March 2020 will not happen all the time. I won't be able to advise on Piramal or IndusInd Bank, so I have no view on the stocks. Like I said, there are stocks where you don't have a view. So as a technical guy, you don't need to make a view on all the stocks, only on the stocks which you like. What is a baseline return can one expect using the strategy? So we are happy with anything above 18 to 20% CAGR over a 5-year period. So I would not like to analyze specific stocks because that will become a recommendation or a problem. I hope this answers most of the questions on the topic we've taken. I don't want it to become a Q&A on a particular stock because that is where, say, I might not have a view on Avanti Feeds, which is clear. The stock could go up 20% and you will blame me, yeah, boss. Aapka to koi view hi nahi tha. If I like a stock, it breaks down. So because in the end, you are looking at probabilities all the time. So I believe we've covered most of it. If you have any queries, etc., please go through the website. And if you're really interested in technicals, read the free ebook. So in your course, so what we do in the course is very simple. It's a 15-hour video course. So all the videos, so for example, the current video which we've done, the whole thing will go into the online course as an additional part. So there are various topics which we cover. So we cover from basics and candlesticks, where to use candlesticks, various moving averages, convergences, chart patterns, practical analysis. So this is where we look at a lot more in sectoral leadership, how to invest on RSI, channels, various topics. So there is a lot of say what softwares are available, how to look at price volumes, equivate indices. So all these topics are covered in detail. And plus, once you've done this course, you can always say go through it for the next 1 year. So it's access to the videos for 1 year. And we've kept it very, very cheap. So I've become and over the years, for example, we used to charge 14,000 rupees for our 2-day course in 2007, and we still charge the same. So there has been absolutely no inflation in the stuff we do because we do it this is not our core business, but this helps us get better. So this is the course which I talk about, the online course, and this is the Analyze with Me. This is more like an advanced thing for somebody who wants to be very active in terms of learning. And this is more like say how it would go. So it's a 1-month course wherein we take various topics. We go a lot more into psychology. We look at the markets, how it is right now, where the breakouts are. So how to scan for stocks, how to create watch lists, then how to do risk per trade, what is risk rewards, how to identify sectors, and then try to take examples. So for example, last 1 month in the Analyze with Me, all we have been talking about IT stocks because IT has been the leader. Then how my daily workflow goes and how you can design your daily workflow in terms of learning. So this is like four particular topics which we cover in those 2 hours, and 1 session which is totally in terms of say queries. And this lasts for almost 1.5 to 3 hours depending on the questions. So this is more like a practical approach and trying to understand the markets as we are in that point of time. So this we used to actually I've actually done 2 YouTube videos explaining this, which has much more detail in the explanation. And this we used to actually do it physically 10 years back, where we used to allow people to come down to our offices and sit with us and analyze in the evenings. Then over the 10 years, it became very, very difficult because of logistics plus travel, etc. involved. So now, because people have become more comfortable with the online part, and even I have become more comfortable talking online, we've been able to structure this new course. I hope that answers the question. I would suggest you go through the video all through. Thanks a lot, everyone, for attending the session. It was great to have people sitting on a Saturday evening, going to Saturday afternoon. And keep reading the website and always keep looking forward. Do send in your, say, suggestions or say whatever you would suggest.